Hey, what's going on YouTube? And welcome back to Tech Conversations. I am your host Guillermo. It is July 20th. Hope you're all having a great day today. As you can see, it is a green day for me, up $500 today, or about 0.5%. So we'll see what the rest of the day brings us. Now in today's video, I want to talk about one of the safest ways to grow your account safely and very quickly. And so this is a great strategy to utilize, and it basically involves us combining many different things that we've talked about in the past. So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Again, this is very helpful, very powerful. And so our goal here is to maximize our income by combining two different separate approaches with a limited risk. And again, in my opinion, this is one of the safest strategies to use to grow your account very quickly. So the ideal situation here is that you really want to buy a stock. You want to buy shares of a stock, but here is a safer approach than just outright buying the stock. It's going to have more reward and it's going to have less risk. So let me show you what I mean. So the very first thing you want to do is you want to go over to a website called barchart.com. So here's the website. Now what we're going to do is we're going to click on options here, and we're going to go to highest implied volatility. So we'll click on this link here. So what this is going to do is this is going to show us stocks that have the options with the highest implied volatility in the market right now. The reason this is important is because remember, IV plays into the pricing of an option. It actually plays into one of the Greeks when it comes to options. So as a general rule of thumb, and it's a lot more complicated than this, but a general rule of thumb is you want to sell options that have high implied volatility. You want to buy options that have low implied volatility. But anyways, this is showing us stocks that have options with the highest implied volatility. So the first thing you want to do, you basically want to just start scrolling down through here, and you want to find a stock that you've already been wanting to buy, that you've been looking into and researching on, and you already want to buy. So for example, if I'm scrolling down this list, let's say I hit CCIV here. Let's say this is a stock I've already been wanting to buy. I was actually going to buy it here very soon. Here is a better approach, right? So we see CCIV is here, and this is telling me the put option at the $40 strike on August 20th has some very high implied volatility. So let's go ahead and let's capitalize on this then. So let me first show you guys here. If I go over to the option strat, what it would look like if I just purchased 100 shares of CCIV right now. So let me refresh this. So it's at 23.11. So if I purchased 100 shares right now, this is what the chart would look like. Again, ignore these. These are canceling each other out. This is what it looks like to just buy 100 shares of CCIV and hold on to them up until August 20th. So my max loss is 23.11. That makes sense because I'm paying 23.11 per share and I'm buying 100 shares. And if CCIV were to go to zero, that would be my max loss. And then I can, tell what my gains or losses are depending on the date, depending on the share price. So again, this is what it would look like to purchase 100 shares of CCIV right now outright. But here's what we're going to do. We're going to go back to Robinhood and let's go to that stock. So CCIV, Churchill Capital. And again, instead of coming here and buying, for example, 100 shares of this stock like you already wanted to because you're bullish on it, what you're going to do is you're going to go over to options. And so remember, one thing that you can do to purchase 100 shares of a stock is selling puts, right? We can sell puts to purchase 100 shares. Now, most of the time, people will sell out of the money put options. Out of the money for puts is where the strike price is less than the share price, right? So it'd be these options here. Now what we're going to do is we're going to sell in the money put options. So here's what we're doing, right? We're first going to barchart.com. We're finding a stock we already want to buy. We want to make sure that it's the put options that have the high IV. Most of the time, it's going to be both puts and calls that have similar high IV. So, even if it was a call, we could probably still do this. But we hit CCIV and it was a put, which is good. So we found options here with high implied volatility, and we're going to combine that by selling puts that are in the money. So we're selling in the money put options on options that have very high implied volatility. And this is going to benefit us here. So let's take a look here at what would happen. So for example, this one was talking about the $40 strike. So let's go up to the $40 strike put option here. So what we could do, so we could sell this put option right here. So remember, when you sell a put, you have to put up collateral. You have to put up whatever the strike price is times 100 in case you have to buy 100 shares of that stock at that strike price. And ultimately, if on the expiration date, which we are actually using August 20th, because that's what that's showing, that's what, bar chart is showing, August 20th. If we sell this put here on August 20th at the $40 strike, ultimately, we want it on the expiration date. We want CCIV to be above the strike price. If it's below the strike price, you're going to be assigned 100 shares at the $40 strike, but that's fine. And we'll talk about that here. But again, as you can see, very high implied volatility on this specific option. The other options around it will also have some pretty high implied volatility. But as you can see, this particular option seems to have some pretty high open interest, does have some volume going on. So it looks like a lot of people are interested in this option here specifically, which of course will affect the implied volatility. That's why it's high. But ultimately, let's take a look at what this looks like, and then I'll just briefly talk about what the benefits are of selling an in-the-money put option. So let's go back to a new window on option strat, and let's go ahead and let's take a look at what this would look like. So ultimately, we're going to go to short put here, and we're going to sell a put on CCIV, right? And so we're actually going to do it at the $40 strike. So we're going to go over here to the $40 strike, and we are already on August 20th, so that's okay, right? So let's take a look here at what is going on. So again, let's refresh this. It's still at 23.12. So as you can see right away off the bat, if we compare this to just purchasing 100 shares outright, what do we see? Well, we see that our max loss over here is 23.11. Our max loss over here is 22.45. So our max loss is less when selling this in the money put option at the $40 strike. That also means our break even is less, right? If I just buy 100 shares right now, my break even is going to have to be 23.11, which is the price I purchased 100 shares of. If I sell this in the money put option instead, my break even is 22.45 according to this right here, which is still lower than what the price is right now. So ultimately, by selling this put option, you're still getting the shares cheaper than what the current price is at right now, right? So again, your risk is less by doing this than just buying 100 shares outright. Now let's take a look at reward. So let's say that by August 20th, since I should be bullish on this to do this, let's say CCIV goes up to $30 a share. Over here, where I just bought 100 shares, if on August 20th it goes to $30 a share, I would make $689. Over here, by selling this in the money put option that has high implied volatility, and that we're capitalizing on that high implied volatility, if it goes to $30, what does this say? You would make $755, right? Again, versus over here was $689. So if I buy 100 shares right now, I'm risking more. And if it goes to 30, for example, on August 20th, I'm only making $689. Over here, if by August 20th it goes to $30, I'm making $755. And again, I'm risking less. My break even is less. So again, by selling in the money put options here on options that have high implied volatility, you are going to be benefiting more than if you just purchased 100 shares outright. And of course, you should confirm it with a tool like this to make sure that, hey, my break even would be less. My max profit, if it were to land on 30, 34, it is going to be more. Max loss is less, things like that. But ultimately, that's what we're doing here. We're combining selling an in-the-money put option, right, on options with high implied volatility. And so, again, really great strategy here because, again, you're reducing your risk and you're basically making more, right? And we can actually take a look at that here, profit and loss percentages. So again, let's say, CCIV goes to 32% on August 20th. That would only be a 38% return. Versus over here, if it goes to $32, let me do that here, right? What would that be? That would be a 54% return. So from a 38% return to a 54% return. So a way higher return, and again, our risk is going to be less here. So ultimately, that is something to definitely check out. If you go into bar chart, find a stock that you already want to purchase. Consider selling in the money put options, especially if you're bullish on that stock. Take advantage of the inflated premiums on that option. And ultimately, again, make sure you're always double checking using a tool like the option strat. Now, very quickly, why would you want to sell an in the money put option? So number one, if you're bullish on the stock and you want to capitalize on intrinsic value as well, not just extrinsic. Remember, extrinsic is just time value, theta decay basically. You want to capitalize on intrinsic value as well. You would want to sell an in the money put option. Number two, let's say you really want to buy CCIV, right? You want to really purchase it. If you sell an out of the money put option, it's a lot more likely that that contract will expire worthless, and thus you won't be able to purchase CCIV, right? Because what could happen is you sell an out of the money put option, for example, at the $22 strike, and when you do that, CCIV moves up to like 35. Well, now next week or whenever it expires, you'd have to sell a put around $33, $32 to do that, and that's all gonna be a lot more risky, right? Now, if you sell an in the money put option like we just did at the $40 strike, it's very likely you'll be assigned the 100 shares. And again, your break even will be $22 or so. It'll be less than if you just purchased the 100 shares. So if you're very keen on actually wanting to buy the stock, you would sell an in the money put option. That gives you a way higher chance that you will actually be assigned the shares, and your break even should still be lower than if you just purchased the 100 shares right there and then. And so ultimately, those are kind of the two scenarios. Now, one other question I'll probably hear is, does that mean I'll be assigned early? There is a potential for you to be assigned earlier, just due to the fact that it's in the money. But ultimately, it's the same thing, right? I mean, you look at the chart, nothing's really going to change if you do get assigned early. Because basically, you'll get the 100 shares maybe a week before or whatever. You can just sell them right away. You can start selling calls against them. You can do whatever you want. So anyways, if you have any questions, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. I hope you enjoyed the video. Let me know what you guys think, and I'll see you guys next time.